I'm in the camp that investors are getting a once in a decade opportunity to invest in the bond market right now. So where's my data to support this? I have some data, but really I just want to focus on 2 points. The first being that the yield you start with in the bond market has historically driven the bulk of returns. And starting yields are higher right now than they were the last decade. So that gives me some confidence. And then second, you have a Federal Reserve that is more likely than not going to be initiating more supportive monetary policy, aka interest rates will be likely trending downwards before they trend upwards over the next 12 to 18 months. So those 2 points are what I want to focus on, and they give me a lot of confidence that you're getting a very good opportunity in the bond market right now. Just looking at that very first point, why does starting yield matter? We can just use a very simple exercise and look at a 10-year treasury bond that's yielding 4%. Let's say you buy that bond at par, $100, and it's yielding you 4% per annum. You wait throughout the 10 years, you don't do anything with it. Prices don't fluctuate because you're not selling it. And 10 years later, you sell the bond, or it matures rather. What was your return?
4%.
It's 4%, right?
Yeah.
You collected the income. And so you can kind of apply that same exercise and methodology to a portfolio of bonds or even a bond mutual fund. The yield you start with is going to drive the bulk of your return over the duration of that instrument. And so the fact that we have starting yields much higher today, roughly 4.5% to start the year of 2024, relative to 10 years ago, say, the last decade in which you really had to reach for yield, and starting yields, as I'm showing it on this chart in blue, were 2.5%. You have an ability to just achieve a greater level of return given that yields are lifted much higher. So I think your starting point obviously gives you a better return proposition, but also at the same time, higher levels of income distribution can help better offset any price fluctuation that happens in the bond market.
Yeah, and you know what I think is really fascinating, as interest rates have moved higher, yields have moved higher, bonds have been hit. It's been a rocky ride. But for investors, most investors that are either nearing or in retirement have some allocation of bonds, and their income from the portfolio has gone up. And so as an investor, what you should be really considering is, if I'm not liquidating my entire portfolio in the next 12 to 18 months, and I'm holding, and I have a long-term approach to portfolio management, the higher yields translate into higher income from the bond component of the portfolio. And I think that's helping out investors that are drawing that income as they enter into retirement.